Good day. Welcome to another lesson on our Super Dealmaker Entrepreneurship Master Program. We are still looking at the skills program, Finance for Non-Financial Managers, or how do you manage finance for your business. Today's lesson, we're looking at a balance sheet, and we'll take you through the balance sheet, how it looks like. Because sometimes if you are a non-financial person, you wouldn't know what the balance sheet looks like. We'll take you through how the balance sheet looks like. Now that you've seen how the balance sheet looks like, right? You understand what the balance sheet is supposed to look like. Then we're going to go into detail in terms of what is a balance sheet. And if you remember, we went through how you maintain the records, like how do you record transactions in your accounting system or Excel or whatever the system that you're using to record your financial information. And we went through how you prepare your income statement, which is your performance state. Call it a performance statement in a way, because the income statement, it shows you how your business is performing. And I think in that lesson I've indicated that it's like your school report, where your child comes back with school report, and then you need to look at it. How did the child perform? The first important thing is, did the child pass? Similarly with the income statement, did you make profit? Then once you check those two, which are key, then you go in detail in terms to see which subject did the child perform on and which ones did they not perform on. And with income statement, you look at the component of the income statement to see where you didn't perform well and what can you do to improve that. So that is your income statement section, right? And as I said, that your financial statement is made up of about 5-6 components, right? Which is your income statement, your balance sheet, your statement of equity, you have your cash flow statement, and you have your notes that support your financials. That's on the financial part of it. And on the reporting part of it, you're going to have your accounting or your audit report or your statement or your compilation statement from the auditors, and you're going to have your accounting policies and all that. And then you start having your financial information. So your financial statement is broad in terms of the content, but today we are focusing on the balance sheet. So what is a balance sheet? Okay. A balance sheet is a statement of the financial position of the business. Meaning, what is the financial position? Remember, with income statement is how you're performing for that specific period. But with the balance sheet, it shows you the position, where are you at a given time, right? So a balance sheet is not a record for maybe a financial year only, because things that goes in the balance sheet are assets, your liabilities, and all those things. So it's got historical information. So it brings how the business has been doing to a certain point to say, currently, what is your position? Are you solvent? Are you insolvent? Are you doing well? As the position going forward, to have strength, to have a proper foundation of going forward to perform. So the balance sheet it tests your strength or your position at a given point. Are you strong at that point, or weak, or average? Whatever your financial position would be. That's what the balance sheet is showing you. And remember, when you go into the funding institutions or when you're selling the business, they will look at your balance sheet. They will want to see the strength of the balance sheet, how healthy it is. So when you analyze the balance sheet, it's like you maybe going to the doctor for checkup. They'll check a few things to see how healthy are you. Are you still strong? Heart rates, your blood pressure, cholesterol, those kind of things. They check your health status at a specific point in time. Okay, now that is like your balance sheet. Remember, I said your income statement is like the report of your child, your school report. It shows you how you perform for that specific year. With the balance sheet, it's like your annual checkup to say, how are you doing? Are you financially healthy? Because as I said, that it brings historical stuff like your financial health, right? If you're not eating well over a period of time, you're not exercising, not looking after yourself, your checkup will show that no, you have this weakness, whatever, you have these issues and you need to clean up here, do this. So it shows your historical, basically your checkup will show the historical impact of certain things that you're doing. Let's say you're smoking, and it'll show your lungs to say, hey, they are losing whatever, they're not as healthy as they should be because you've been smoking over a number of years. Like the balance sheet, your assets, your liabilities, if you're not paying your liabilities, they'll continue increasing. And if you continue using your assets, the value will continue decreasing. So your financial health will not look good when you check it at a specific point in time. So the balance sheet is different in how you look at it compared to the income statement. It's for that year. The income statement is the report for that year. Okay. Now next year starts fresh. You start from zero. Obviously you'll be in the next grade, but you start from zero and you perform for the year. At the end of the year, you evaluate, you see where you are. The following year, you start from zero. But with the balance, that's the income statement. With the balance sheet, you do the checkup now to see your financial health. Then when you're going to do the checkup, what you did previously is not written off. If you've been exercising and eating healthy and all that, it will show here. But the results of you being healthy for a long period of time will also reflect when you do your next checkup. So basically with the balance sheet, it shows you the financial position, your health or your business health position at a specific point in time. So those two, even when you are reading them, you must keep in mind how you read them. You don't read them the same, or you don't interpret them the same. You need to look at them in this context to say the income statement is the financial report for the year. The balance sheet is the financial position as a given date, meaning taking into account all your historical stuff. It's your health check at a specific point in time. That's the balance sheet for you. And then the cash flow is similar to the income statement, but it's more focused on the cash. What is your cash position? It takes the two into account, the balance sheet and the income statement. But the cash flow will deal with it when we are dealing with the cash flow module. All right. So what goes in the balance sheet? Okay, that's very, very important to understand, because we spoke about the things that goes into the income statement when we're dealing with the income statement, right? The type of transactions that supposed to go into the income statement. Now we're going into the type of transactions that goes into the balance sheet, right? In the balance sheet, it's basically they call it an accounting equation. Okay, accounting equation is which is the assets should be equal to your assets and liabilities. If you could understand this concept, then you understand the balance sheet. You wouldn't struggle to understand what's supposed to go where in the balance sheet and how to read it. Okay, so your assets supposed to be equal to your assets supposed to be equal to your liabilities and equity. Okay, now I'll break down what is an asset, what is a liability, and what is an equity, so that you understand why this equation is important, because your balance sheet must always be balancing. So what you do, as I've shown you on the balance sheet, you have the top section, which is the assets. You put all your assets in one side, then your assets should be equal to your liabilities. For example, maybe I'll use this thing here. Let's say this is your asset. These books here and the Kindles are your asset. Then these specs are your liabilities, and this is your equity. So this weight must always be equals to this weight. That's what the balance sheet does. That's how the accounting equation works. To say your assets must always be equals to your liabilities and your owner's equity. So that's how you're supposed to interpret your balance sheet. And if you can see from the demonstration or the indication of the balance sheet, we showed you that on top you have your balance sheet, right? And you have your assets. Then at the bottom you have your asset, you have your liabilities, and you have your owner's equity. So if you add together all your assets, your owner's equity, and your liabilities must always be equals to your assets. That's the basic of a balance sheet, and that's how accounting works. So this is the basis of accounting. This is an accounting principle that you need to always keep in mind, to say your assets must always be equals to your equity plus your liabilities. So the two sides must always be balancing. If they're not balancing, then there's something wrong. Your books are cooked. All right. So what is an asset? Okay. Technically, the asset is something that is owned by the business. You know how much you paid for it, and you're going to use it to generate income going forward. So the asset is something that you pay, or you know the cost, you can measure the cost, you know how much you paid, you own it, and it's going to help you generate income going forward. So it's like if they say you are an asset to this business, that means you will generate income, or you will generate benefits for this business going forward. That's what the asset means. So in the financial sense, an asset is like if you have a factory, the equipment in the factory, or the factory itself, the building, the equipment inside, those are what we call the assets. Meaning you're going to use those things to generate your income or derive economic benefit from those assets. Might not be directly that you use this to generate income, but you're going to derive the economic benefit from those assets. That's what is an asset, and the example of an asset is the laptop. Okay, laptop, you buy it, you pay for it now, but you're going to use it over maybe 3 years, 4 years, whatever, for a number of period of time. So you buy it now, but you're going to generate the revenue going forward, right? That is called an asset, which is different from an expense. When you're talking about the income statement, we're talking about expenses. Expenses are the things that you pay and you enjoy the benefits now. You pay the rent and then you get an opportunity to stay in the office. You pay the telephone, you use it, right? You pay for printer, you benefit now. You pay for maintenance so that you will be able to print. So the expenses are the things that you pay for, but you get the benefit now, right? With the assets, you pay now, but you get the benefits over a period of time. If it's a laptop, you pay for the laptop now, but you're going to use the laptop for some time to whatever facilitate, to send emails. So you'll be getting benefits from this laptop over a period of time. That's why it's called an asset. Okay, the furniture. You're going to sit here on this furniture, do the facilitation, run the trainings over a period of time. It's not a once-off. You don't pay for the desk and then you use it today and then it's gone. Then that will be an expense. But if you buy it today, you're going to use it over a period of time, then that becomes an asset. right? And remember, when we were doing the income statement, to say these assets, you used it over a period of time, but you depreciate them, meaning as they go, they lose value. So over time, this laptop must be worth zero in our financial books, because as you use it, it becomes old, non-functional, and because we are continuously using it, so we need to depreciate it. Depreciation is the percentage that you allocate to say this laptop will lose value, economic value for the business, right, over a period of 3 years. So we're going to depreciate it for maybe with 33%. So that means every year the laptop is going to lose 33%. That is what is called depreciation. So the assets that you have in your balance sheet, they need to lose value over time. They need to be depreciated, because like anything else, like even you, as you grow, you lose value, but you lose strength, you lose your beauty, you lose certain things because you are aging. Similar to the asset. As it ages, it doesn't perform as it should. And rightfully so. Based on accounting, you need to depreciate that asset. It must lose value. Because if you can present it in your financials with the same amount, you will basically be misleading. Because you'll show this laptop is, 5,000. You show it over a period of time to say, I have an asset that is worth 5,000. But while in reality, if you go out in the market, they'll say, no, this thing of yours is old. We can give you 500 rand. So it means even in your financial statement, you were supposed to show the laptop based on its true value, which is called carrying value. Carrying value or book value is you take the cost, you minus the depreciation, then you get the carrying value. That's the amount that you're gonna reflect on your balance sheet. Always, you don't carry the assets in your balance sheet at cost, because that will be misleading. You might be showing that you have an asset that is worth 5,000 rand, to only find out that your actual value is 1,000 rand, for argument's sake. So the presentation of the health, remember when we started, we said that the balance sheet shows the health of your business. So if you show the asset as 5,000 rand, the laptop is 5,000 rand, then you will be misrepresenting the health to say you have an asset that if you can sell it today, you can get 5,000 rand. While that will not be true, because it would have lost value over time. So that's where the concept of depreciation comes in, right? You depreciate it over time. As it loses value, you need to reduce the value of that asset in your books. That's how you calculate depreciation. The term depreciation, that's what it means. Continuously, you need to reduce that value. And remember, as you reduce the value, you get the cost. This year, you reduce maybe 20%. Then you're going to have 80% as a carrying value in your book. That's what should be reflected in your balance sheet. Next year, you have the cost, but last year you took out 20. This year you need to take out 40. So you're going to have 60% reflected in your books next year. Year after, you're going to have 40% reflected. That year, 20%. The other year, you're going to have 0 reflected. Even though the asset will be here, you just have to show it as 0 or 1. That's how depreciation works. Every year, you take out the percentage of the depreciation from the value that you're going to show in your balance sheet. I hope that makes sense in terms of the depreciation. So now I was looking at the asset side. That's how you account for the asset. That's how you record the asset. And that's how you're supposed to interpret it. If you see an asset value in a balance sheet, even if you are reading someone else's balance sheet, you must know that is not the cost of that equipment. That is the carrying value. Or it should be. Not all the time people do what they're supposed to do. So when you're looking at the balance sheet of a business, you need to know the assets that you see there on that balance sheet is not the cost of that asset. It is the carrying value of that asset, meaning they took the cost, they minus the depreciation over a period of time, then they show you how much the carrying value of that asset is. That's what an asset is, and that's how it's reflected in your balance sheet. Okay. And you must remember that even the funding institution or whoever you are doing transactions with, they look at your financials, they look at your balance sheet. They want to see how healthy you are. So if you show your assets without taking out your depreciation, then you will be misleading in terms of the financial statement. They won't be showing the true income or the true assets of the business. So the health check that a person will be doing will be incorrect. Okay, so that is the asset side, right? Now, remember when I started with the accounting equation where I say the asset must be equals to your liabilities plus your equity. So what is okay, before we get to the liabilities, maybe on the asset side, I spoke about the equipment portion of the asset. I forgot to touch on the other assets. So we have that's the equipment side of the asset, right? Then you have other assets. Other assets can be the long-term ones. It could be your loans or investments that the business has made and all those things, because you're still going to derive future economic benefit from those assets. So if you have investment, obviously investment grows over time, and you can, not all the time that you're going to get economic benefit, but in principle, generally, you'll get the interest and the investment growth, whatever it is that you invested in over a period of time. So you'll continue to get economic benefit. So if you spend money, maybe buying an investment, that becomes an asset in your books. Okay, so you must recognize it as an asset. It's not an expense if you are investing, because you are not getting the benefit now. You are getting the benefit over a period of time. All right, that is on the long-term asset. Or somebody, if the business borrows someone money, that becomes an asset, because in future you're going to get the money back. Even though you spend it now, it's not an expense. You need to record it in your balance sheet, because you spend the money now. You took out the money now out of the business, but you're not getting the benefit now. The person is only going to pay you in future. So it means you need to recognize that loan that you gave to that person as an asset in your business. And if it's going to pay you, the repayment are over, they are more than a year, then it becomes a long-term asset. Okay, talking about long-term asset, we have long-term assets and we have short-term assets. So for now, I've been focusing on long-term asset. I spoke about the fixed assets or the equipment or the physical assets. Now I just touched on the loans and the investment, which are not necessarily physical assets, but these are long-term. When you're talking about long-term in finance or in accounting, it means you're going to enjoy the benefit for more than 12 months. If you're going to enjoy the benefit for more than 12 months, then that becomes a long-term asset or a non-current asset. That's the fancy word for it. But if you're going to you're not enjoying the benefits today, but you're going to enjoy the benefits but over a period of time, but not more than 12 months, then that becomes a short-term asset or current asset in an accounting term. So your current assets are those assets that you're going to derive benefits from within 12 months, using your financial year end within 12 months. And your long-term assets or your non-current assets are the ones that you're going to derive benefits for more than 12 months. That becomes long term. That's in the accounting. And the current one are the ones within 12 months. You're going to enjoy those benefits. Now, which assets are part of your current assets? Remember, when we looked at the balance sheet, right? I showed you the assets. We showed you the long-term assets. I showed you the current asset. Or I showed you the non-current asset. I showed you the current asset. So on the current assets, you're going to have the stock. You have the debtors. You have the bank. Or if you have a positive bank account. Because if it's negative, then you say it's a liability. You have the bank. And then you can have other accounts receivable, which are money that you paid in advance. Like if you prepaid for something, then that's other accounts receivable. So in the current assets portion, you have your stock. So basically, you need to check when you're preparing the financials to say at this date, which normally it will be at the preparation date, the date that you're preparing your balance sheet for, right? You check what is the value of the stock that I have. Then you take that amount, you put it in your balance sheet as under your current asset. Why is it an asset? Because when you sell it, you're going to make money. That's economic benefit, right? Then you have your debtors. Let's say in your business you sell credit. People owe you money. So you need to know at the date that you're preparing the balance sheet for. It can be either at financial year end or for management account. At that date, how much am I being owed? I'm owed by my debtors. Then that's the figure that you put in the balance sheet. On that date, you check your balance, your cash balance. How much do I have in the bank? If it's positive, you put that amount. And you check if you have any other short-term debts that you can put, that people are owing you, but they're going to pay you within the next 12 months, then you put it there. The total of this will make your current asset. And you remember earlier we spoke about the fixed asset, or the long-term assets, or the non-current asset. So if you add these two, they will give you your total assets. That's the value that you are going to compare with your liabilities and your equity. So this total of your total assets, which will be made up of your current asset and non-current asset, then it will make your total asset. And this total asset, you're going to compare it with your liabilities and your equity. So this total here of your total assets must be equal to your liability and your owner's equity. Right, now we spoke about the assets, right? To how you get your asset figures into, on your balance sheet. And remember, we spoke about asset accounting equation, which is asset must always be equals to your liabilities and your equity. Okay, now let's start with the liabilities now, because we finished the one side of the equation. Now we're going into the other side of the equation. Liabilities are, remember, it's sort of an opposite of an asset. It's when you have an obligation, a legal obligation to pay someone. Now, this is the business, right? When you have a legal obligation to pay someone, then that becomes your liability, sorry. You have a legal obligation and you know how much you need to pay them. And legally, you are legally obliged to pay that person. Then that becomes your liability. Like your asset, your liability can be broken down into your current and the long term. Or call it non-current, which is long-term liabilities, and you have your current liabilities, which are the ones that are paid within 12 months. The long-term ones are the ones that you're going to pay over a period of time. But I'll go into detail in terms of what you classify as a long-term liabilities or non-current liabilities. So if you look at the balance sheet, if you have a balance sheet, looking at any company, maybe you might be evaluating a company, JSE, whatever, you might have shares, whatever it is that you have, and you're interested in their financial health. Obviously, you're going to look at the assets and you look at them the way I've explained. You will understand what do these figures mean. On the other side, you look at the liabilities, right? When you look at that, we have a long-term liabilities. So generally, the long-term liabilities will be if the company has or the business has a bond over a property, if it's got assets that it purchased on a finance lease, if there are shareholders loans. Remember, when you start a company, you generally put in money as a shareholders loan to start the business, whatever, to fund the business. That becomes your shareholders loan. And then there might be any other long-term loans. I'm talking long-term loans now, or non-current liabilities. So these are liabilities that it will take you more than a year to pay. So you classify them as non-current. Then, as I said, it's bond, it's your finance leases, your shareholders loans, or any other funding. No, not any other funding, but any other loans that the business received. That needs to be repaid over a long period of time. Those are your non-current or long-term liabilities. And generally, if it's a bond or a finance lease, you have a current portion. So on top there, when you're showing your non-current or your long-term liabilities, you show only the portion that will be paid after 12 months. The portion that will be paid within 12 months of that loan, it must be shown in the current liabilities. Okay, maybe I'll repeat this. Let's say you owe me 100 rand, right? But you need to pay me 10 rand every year. Under long-term loans, you're going to show that you owe me 90 rand. Then under the short term, you're going to show that you have a short-term portion of 10 rands. So the total that you're showing in the balance sheet will still be 100, that you owe me 100 rand, but you have to pay me the 10 rand within 12 months. Then you record it under your current liabilities. So all the short-term portion that you see in the balance sheet where they say short-term portion, that is a portion of a long-term loan, but they take that portion that they're going to pay within 12 months, they record it under your current liabilities. Okay. That's all the loans. You treat them the same. It can be a bank, whatever, a bond, finance lease. You take under non-current liabilities, you only show the liabilities, the portion that you're going to pay after 12 months. The liabilities that you're going to pay within 12 months, then you show it under your current liabilities. That's how you record your liabilities in your balance sheet. It's very, very important that you understand this concept, so that when you're reading and interpreting the financials, you understand when you see the current portion of the loan in the current liabilities, or you see long-term portion in the non-current liabilities. You need to know that they've split the two. So in your mind, you can either go to the notes, because remember the income statement they have the notes component, things like loans, assets, okay, long-term non-current assets, they have a note next to it. So the note, it helps you to give you a little bit more detail. So because there are certain transactions or there's certain entries or whatever that are in your balance sheet or income statement or cash flow, but they need more explanation. So what happened is they put a note next to that item, so that if you want more explanation, then you can go to the note and then you can read more about what it is. But sometimes it might be one figure and you can't understand what makes up this amount. Then when you go to the notes, That's where the notes will tell you what exactly is what's going on with that amount. So it's very important to understand that why do they have notes next to the figures when you're reading the financials, is to give you a little bit more information on that specific item. All right. So when it comes to liabilities, those are the long-term liabilities, right? And then you have your current liabilities. So your current liabilities, generally, it will be your accounts payable. Accounts payable is when you buy on credit. Let's say you have your good relationship with your suppliers and they're willing to give you credit, to say, buy from us, you can pay us after 30 days. Then that portion, at that specific time that you are reporting, if you owe anyone money that you have to pay within the next 12 months, makes up your current portion of your current, goes under your current portion and the current liabilities. That's where that portion goes in. So you need to make sure that you understand that what is the current liability, what is the accounts payable. Accounts payable is where the portion of your creditors, if you have to pay them within the next 12 months, they sold you stuff on credit, then you record it as accounts payable. Okay. Then when you're talking about you can have other liabilities, like other short term. It might not be from your suppliers. It might be that you owe someone something, whatever, but you're going to pay them within the next 12 months. Then you record it under your current liabilities. Then, as well, if you have an overdraft facility, you owe people money, then, not people, but the bank. Like when you have an overdraft, that means you use the money that you didn't have. So you owe them that money. So it shows you as a current liability. So at that specific time, you need to record that as current liabilities. You need to record that overdraft as your current liabilities because you're owing it and you have to pay it within that specific time. And the other common current liability is your SARS. When you have your tax assessment, your VAT, other things, if you didn't pay them, you generally record them as your accounts payable. Then, because they are current, you need to pay them within the next 12 months. So it becomes your tax payable, VAT payable, then you record them as your current liabilities. So the current liabilities section and your non-current liabilities or your long-term liability section, they make up your total liabilities, right? And then we're going to have equity. Remember, we said assets must be equal to liabilities and your equity. So the total that you have now, we have a total of liabilities, meaning we have the long-term liabilities and we have the current liabilities. We have the total of liabilities. Now we're going into the portion of your equity. What is equity? When you read the balance sheet, you see equity. So equity is the value of the shares. Generally, small businesses, the value of the shares, you see like they have 100 Rand or 1,000 Rand because you're not trading in shares, whatever. Your shares, they will have what they call par value. A par value is the amount that is allocated to a share. So if you run a business, and generally when you even register, I don't think entrepreneurs are even considering that. But you need to know how many shares have been authorized, right? Authorized meaning how many shares does your company have? Because in your memorandum of incorporation, the shares are addressed there. Excuse me. The shares are addressed there. In the memorandum of incorporation, you see that this is the number of shares that are authorized by the memorandum of incorporation, and this is the par value of those shares. Par value generally normally is 1 rand. So you'll find that a business has 100 shares with a par value of 1 rand, meaning the authorized shares of that business is 100 rands, right? Now, depending on how many shares have been issued, meaning when you register a business, there must be shares that have been issued to the shareholders. Okay, you have authorized. Authorized meaning those shares are the shares that are available and can be issued to the shareholders. Then you have a portion of issued shares. Those are the shares that have been issued to the shareholders. Okay, so when you go to your balance sheet, your share capital or your share portion will be the number of shares that have been issued, not authorized, have been issued, multiplied by the par value of those shares. That you get from your memorandum of incorporation. It must be the first line in your equity section of your balance sheet. That's how you read your balance sheet. Okay, that's the first line. You need to understand where that figure is coming from. If you are looking at a listed company, it will be the number of shares that have been issued, meaning the number of shares that are in the hands of the shareholders, right? And multiplied by the share price. Remember, the listed companies, the share price is listed on the stock exchange. So if you look at their share capital, you look at how many shares did this company issue, what was the share price on this day. Then if you multiply the two, it will give you the value of the share capital. But that's now for listed companies or bigger companies that have many shareholders and they have additional share capital in there. But for our businesses, the small ones, it's just the issued shares that are in your memorandum of incorporation multiplied by the par value of those shares as recorded. Generally, it's one rand. And generally, the number of shares that are issued is 100. It could be 1,000 that are authorized and only 100 is issued. And then to see how much of the shareholding you own in the business, okay, maybe just a side, it's got nothing to do with the balance sheet. To see how many shares or the percentage of your share ownership in the business, you need to take the number of issued shares. You take the number of the shares that you own, you divide by the number of shares that have been issued. Okay, then you will know the percentage of the business that you own. You'll know the percentage that you own. Generally, you find, we own it 50-50, whatever it is, right? Only when you go to their share certificates and issued shares, they don't talk to what these people are saying. And I know when you go into partnership or you have shareholders, you take it lightly. But if it gets to the legalities of it, they're going to see how many shares are authorized, how many shares are issued. Only those shares are issued can be allocated to different shareholders. So if you say you have a certain percentage of shareholding in a business, you must know for sure that this company has so many shares that have been issued. I have so many shares. That one's got so many shares. That one's got so many shares. So you need to be clear on that one. Understand what is share capital, number of shares that are authorized, the number of shares that are issued. Okay, so I took a little bit of a detour just to explain that line, the share capital line, so that it's clearer. When you're reading your balance sheet, you must be clear. You must understand what does this thing mean. Because without you understanding that, you just seeing the numbers there, you will not be able to interpret what does this number mean. But I had just had to add that to make sure that you understand how the authorized and issued shares work, so that when you go into business transactions, you are switched on to understand that this is how these things work. And even when you are entering into your shareholders agreement, whatever, it must be linked to your memorandum of incorporation, how many shares are authorized, issued, and all those things. So these are the administrative things that we generally ignore as entrepreneurs, because we are more interested in making sure that the business is running, is profitable, and all that. We forget this little administrative stuff that we need to make sure that we tie. That's the share capital. And the other main component, okay, you can have other things like your convertible pref shares, depending on how you are funded. But we're not looking into complex structures. We're just looking at the basic balance sheet of a basic business. Complex structures, yes, as you're growing in all those things, you'll just add that knowledge. So these are just for the basic things for non-finance people, non-financial entrepreneurs, to be able to interpret a balance sheet. When they're looking at the balance sheet, they need to understand what we're talking about. All right. So now we're looking at the equity portion now in the balance sheet. Okay. Then after the share capital, then you have the retained earnings or accumulated profit, whatever the term you want to use. If you can see, the accumulated profit is the profit that the business has made over a period of time. So it takes things from the beginning, the profit that you've been making over a period of time, then that's the figure that you will see in the balance sheet as retained earnings. Right. So what is, sometimes you pay dividends and all those things. So those will be deducted from your retained earnings. So to see the profit that the business has generated over a period of time. Remember, the profit in the income statement is only the profit for that financial year, right? But in the balance sheet, you accumulate it. You take the profit for that period, you add it to the existing profit. Next year, you're going to take the profit from that financial year, you add it to the profit. The other year, same story. You keep on adding it. It will give you the retained earnings. That's what is recorded in the balance sheet as part of your equity. Okay. So now you add the two, they will give you your total equity in your balance sheet, which is the figure that you need to add it with your total liabilities. It must give you a total. That total must be equal to the total of your total assets. So the total of your owner's equity plus your liabilities must be equal to your total assets. That's how you read the balance sheet. That's how you'll understand how to interpret the numbers that are on your balance sheet. The total assets must always be equal to your liabilities and owner's equity total. So the two must be balancing. If they are not, then you have a problem. And sometimes you can have your negative, earnings, right? Where you're not making, the business hasn't been making money. So then that means you need to fund your business using the liabilities, because your equity will be negative. So if you have a negative equity, that means you have more liabilities. And if you have more liabilities, that means your liabilities on their own, right, without the equity portion, they will exceed your assets, because your equity will be negative. So it reduces that. Your total will be equal, but your liabilities will be more than your assets. So once you get into a position where your total assets are less than your liabilities, or your liabilities are more than your total assets, then you are technically insolvent. Or that business that you're reading the financial for is technically insolvent. And a business shouldn't operate when it's technically insolvent, because the directors will be deemed to be reckless and all that, unless the liabilities get subordinated, meaning they need to be converted in a way to become equity. so that your business is not technically insolvent. So when you get to a point where, this is the key thing, where you see your business is healthy or not, your liabilities must not exceed your assets. Because if you get to that point where your liabilities are exceeding your assets, you need to know that your business is technically insolvent. And you're not supposed to be trading when your business is technically insolvent. That's one key area that you need to look at when you're running a business and when you're reading your balance sheet. That it needs to be technically insolvent. Or you need to be technically solvent. Because operating while you're technically insolvent, it becomes a bit it's illegal. You're not supposed to operate unless you subordinate your liabilities, or you call it converting your liabilities in equity. Subordinating your liabilities, meaning you say these liabilities will not be repaid until the company is solvent. Basically, you're converting the liabilities into equity, because you're not going to pay the liabilities until the company is technically solvent. That's basically a subordinating is. And you find that the bank, let's say a bank gives you a loan and you are technically insolvent, but you have the shareholders' loan there. You have put in your own money. They'll say, no, you need to give us an agreement or whatever to subordinate your loan to our loan. Let's say a bank gives you 2 million rand, you have put in 2 million rand, right? But you have been making losses. And then your total assets and liabilities is 3 million rand. And your assets is 3 million rand. But you have 4 million rand liability. So the bank will say, you shareholder, please sign this document that says you will not take out money from the business until we are repaid. Because if they lend you money and you are technically insolvent, then they were being reckless. You might take them to court to say that's called reckless lending. And our NCR and credit environment discourage reckless lending. So you'll see the funders, they will be finicky. When they're looking at your balance sheet, your liabilities must not exceed your assets. You have a problem, you need explanation. And if you don't have the liabilities that you can subordinate, then you have a problem. You won't be able to raise funding, or even the valuation, you have a negative value when it comes to the business, when you're evaluating your business. So that's what you look at when you're looking at the balance sheet. And then, we're going to go into the ratios, because we have a module on how you analyze the ratios. Because how you use the balance sheet, yes, you look at the solvency, the health. Are we liquid? Are we solvent? Meaning, liquid means you have short-term funds to run the business in a short term. Solvency means long-term. You might not be able, your liabilities exceed your assets. You are insolvent. You can have assets that are long-term and liabilities that are short-term. Meaning, you need to pay these liabilities in a short space of time. You might not be able to do that because your assets are long-term. You don't have cash in the bank. You have factories and buildings, but you don't have money today. You might have assets, but you don't have money today to settle the short term. You need to pay rent tomorrow. You need to pay money into the overdraft. You have the assets, but you don't have liquid cash or liquid asset that you can use to pay your short-term loan. So that's where the liquidity comes in. You become illiquid. But solvency is when your assets exceeds your liabilities. So those things are the things that you, when you're reading the balance sheet, are the things that you need to look at. Make sure that you understand. Make sure that you're not, one, you are not illiquid. Two, you are not insolvent. So that your business can survive, can operate into foreseeable future. And you know that when you're submitting your financials, when they look at your balance sheet, they should see that your business is healthy. But you're using the balance sheet to see how healthy is your business. That is our lesson on balance sheet. But remember, as well, as much as we spoke about the income statement, the balance sheet, remember these things, you don't read them in isolation. You need to make sure that in combination. But this now, it will show you when we're doing the ratio analysis, to show you that some figures that you get from your balance sheet, you need to use them to calculate certain ratios, so that you can see the liquidity, the insolvency, the profitability, the efficiency, and all those things. But those ratios will go in detail when we're looking at our ratio analysis module. But for the balance sheet, this is it. You just need to be able to understand the assets. You need to understand the current assets, non-current assets, liabilities, non-current liabilities, current liabilities, and the equity. Make sure that both the asset equals to liability plus owner's equity. The two must always be balancing. And you need to understand that for you not to be reckless, your business needs to be technically solvent. And to make sure that you are efficient in how you operate, make sure your business is liquid. All right, I thank you. That is our lesson on the balance sheet module. The next one is we'll be looking at cash flow.